Welcome to the deep dive. Today, we're really getting into something important for anyone in Korea investing or thinking they're investing in the U.S.
That's right. We're talking about U.S. passive income taxes. It sounds complex, but, well, we're here to make it clear.
Exactly. Our goal is to give you that shortcut, understand the basics, the key strategies, so you can manage that U.S. income effectively.
We'll break down how the U.S. sees your income, how it's taxed, and, yeah, most importantly, how you can legally pay less tax.
Okay, so let's start at the beginning. What's the absolute first thing a Korean resident needs to get their head around? Their status, right?
Yeah, absolutely. The first crucial step is knowing your U.S. tax status.
Yeah.
As a Korean resident, you're generally classified as a non-resident alien, or NRA.
NRA. Got it. And why is that specific label so important?
It's key because NRAs are typically taxed only on income that comes from U.S. sources, not your global income.
Ah, okay. So the IRS isn't interested in income from, say, Korean stocks, only the U.S.-based stuff.
Precisely. They care about money made in the U.S.
That makes a big difference. Now, you mentioned U.S. source income. I hear it splits into two main types for NRAs, something like FDAP and ECI.
You got it. Fixed, determinable, annual, or periodical income, that's FDAP, and effectively connected income, ECI. They're taxed very differently.
Please break that down. What's FDAP?
FDAP is kind of the default for most passive income. Think dividends, most interest. The big thing, it's taxed at a flat 30% rate.
30%? Flat rate?
Yep, and it's on the gross amount. No deductions allowed.
Wow, okay, so no subtracting expenses.
None for FDAP.
Yeah.
And the tax is usually withheld at the source. Your U.S. broker just takes it out before you see the money.
Okay, simple but potentially expensive. What about ECI then?
ECI is income connected with a U.S. trade or business. Now, here's a crucial point. Certain FDAP income, specifically U.S. rental income, can be elected to be treated as ECI.
Elected, so you can choose.
You can choose. And if you do, or if income is naturally ECI, it's taxed on a net basis. So income minus allowable deductions.
Ah, so you can subtract expenses with ECI.
Exactly. And it's taxed at the regular progressive U.S. tax rates. Just like a U.S. citizen's business income, it's usually much better.
Okay, that distinction is huge. Let's talk investments first, dividends, interest. You said 30% default withholding? How does that play out?
Well, yes, the default is 30%. But here's where the U.S.-Korea tax treaty comes in. It's like your shield.
A treaty shield. I like that. How does it help?
It significantly lowers those withholding rates. For example, portfolio dividends drop from that 30% down to 15%. General interest goes to 12%.
15 and 12%. Much better than 30.
Definitely. And some interest, like portfolio interest, is already exempt 0% under U.S. domestic law anyway.
So how do you actually get those lower treaty rates? Does it just happen?
No, it's not automatic. You need to be proactive.
Yeah.
You must give a valid form, W-8B-BIN, to your U.S. brokerage firm.
W-8BN, that's a key form.
That's the one. Let's say Minjun in Seoul gets a $2,000 dividend.
Yeah.
Without that W-8B-BIN, they withhold $600. That's 30%.
Right.
But if he provides a valid W-8BIN, they only withhold $300, which is the 15% treaty rate. He saves $300 right there.
That's a very clear example. Simple form, real savings. Okay, let's switch gears to U.S. rental property. You said that can be elected as ECI. Why is that so important? What's the default?
The default for rental income is FDAP. And remember what that means.
30% tax on the gross rent, no deduction.
Exactly. Imagine getting $3,000 a month in rent. That's $900 in tax withheld, even if your mortgage interest, property tax, and repairs almost eat up the whole run. It's exceptionally punitive, a real trap.
That sounds awful. So this ECI election is the way out.
It absolutely is. Under the tax code, Section 871 BO-D, you can make a formal election to treat that rental income as ECI.
Okay, how do you actually do that?
Two main steps. First, you make the election itself on your U.S. tax return, Form 1040-NR, the non-resident alien income tax return. You usually do this the first year you have the income.
File a U.S. tax return. Got it.
Yeah.
And second,
you give a Form W-8 ECI to your property manager or whoever collects the rent. This tells them to stop withholding that 30% FDAP tax.
W-8 ECI this time. Okay.
Right. And to use that form and to file the 1040-NR return, you'll need a U.S. individual taxpayer identification number, an ITM.
An ITIM. Okay, another piece of the puzzle. Can you show us the difference this ECI election makes, maybe with numbers?
Oh, definitely. Let's say you have a property. Gross rent for the year is $36,000. But you have expenses, mortgage interest, property taxes, repairs, depreciation totaling $33,500. Pretty common scenario.
Okay, 36 in, 33.5 out.
Right. Now, if you don't make the ECI election, you're stuck with FDAP. Your tax is 30% of the gross rent, $36,000. That's $10,800 in U.S. tax.
$10,800, even though the net profit was small.
Exactly. Now, make the ECI election. Your taxable income is net income. $36,000 minus $33,500, which is $2,500.
$2,500.
Right. Apply the lowest U.S. tax rate, say 10%. Your U.S. tax is just $250.
$250 versus $10,800.
Yes. That's a saving of over 97% in this example. It's a no-brainer, really. Making that election is almost always the right move for rental property.
That is genuinely stunning. Okay, so you've managed the income, made the election. What about when it's time to sell the U.S. property? Any special rules?
Ah, yes. Selling U.S. real estate triggers FRPA, the Foreign Investment in Real Property Tax Act.
FRPTA. Sounds serious.
It is, in a way. Under FRPTA, the buyer of your property is legally required to withhold 15% of the gross sales price.
15% of the whole price, not just the profit.
Correct. 15% of the total selling price. It's critical to understand this isn't your final tax liability. Think of it like a mandatory deposit.
A deposit to make sure you pay any capital gains tax owed?
Exactly. The U.S. government wants to make sure it collects potential capital gains tax from foreign sellers. Even if you sell at a loss, technically, that 15% still gets withheld initially.
Wow. So how do you settle up the actual tax and get any excess back?
You file a Form 1040-NR tax return for the year of the sale.
Yeah.
On that return, you calculate your actual capital gain or loss, figure out the real tax due, and claim the 15% FIRPTA withholding as a payment. If it was too much, you get a refund.
Okay, so you get it back eventually through the tax return. Is there any way to reduce that 15% upfront?
Yes, there is. You can apply to the IRS before the closing for a withholding certificate using Form 8288-1. If you can show your actual expected tax will be lower than 15% of the sales price, the IRS might authorize the buyer to withhold less or even nothing.
Good to know there's an option there. So listening to all this, compliance seems really key. Filing returns, getting that IT on. What are the risks if you don't?
The risks are significant. If you made that ECI election for rental income, you must file that Form 1040-NR each year. Same if you need it for a FIRPTA refund. And the ITIN is essential for all of this.
And penalties if you slip up.
They can be severe. For instance, let's say you elected ECI for your rental property, but then you just don't file the required 1040-NR return on time. The IRS can actually disallow all your deductions for that year.
Disallow everything, you mean to revert back to?
Back to taxing you on the gross rent at 30%, plus potential penalties and interest for failing to file and pay. It completely wipes out the benefit of the ECI election if you don't follow through with the filing.
Okay, message received. Compliance is not optional here.
Definitely not. It pays to do things right from the start.
Right. So let's wrap this up. Key takeaways for our listeners in Korea managing U.S. income.
Okay, first, understand you're likely an NRA, taxed only on U.S. source income.
Second, use Form W-8 BPEN with your broker to get those lower treaty rates on dividends and interest. Big savings there.
Third, for U.S. rental property, always make that ECI election via Form 1040-NR and use Form W-8 ECI with your property manager. That avoids the 30% gross tax trap.
Fourth, when selling property, understand FIRPA means 15% withholding up front, but it's a prepayment towards your actual capital gains tax, refundable via Form 1040-NR.
And finally, fifth, compliance is crucial. File your 1040-NR if required, get that ITN early. Don't let procedural mistakes cost you thousands.
Excellent summary. It really seems like being proactive and understanding these few key forms and elections makes all the difference.
It truly does. What's fascinating is how these specific rules, FDAP versus ECI, the treaty benefits, the ECI election, understanding them transforms potential really painful tax traps into opportunities for significant savings. It empowers you to actually optimize your U.S. investments.
A proactive approach for optimized returns. That's a great note to end on. Thanks so much for breaking this down.
My pleasure. It's important stuff to know.